The Money Show.
Personal Finance with Warren Ingram.
Lots of you send us emails, lots of you contact us, and we do our very best to put those emails into what we talk about on The Money Show. Jono, for example, in Cape Town has come through with a great question, which we'll answer this evening. But if you want to get your voice on the radio, if you want to get your voice heard, if you want to ask a specific question, you can send us a WhatsApp anytime, but do it during The Money Show, because otherwise the WhatsApp line gets so busy. And it just your question will disappear. But so in the next 10, 15 minutes, if you've got a burning question, anything to do with money, send us a WhatsApp on 0727021702. And if we don't get to it today, we'll get to it another day. We promise. We will select your questions, and the best ones will make it through, and we will then use them to torture Warren. Because he loves a good torturing. He loves a good challenge. He loves to be put on the spot, as Warren Ingram, Executive Director at Galileo Capital and personal financial advisor. There's a fabulous story that you've come across, Warren, and it's all about investment products. And this is a particular investment product that seems to have been sold to people as part of their offshore allowance. They could take that money and buy themselves an offshore pension. And it's turned into a bit of a sticky problem. A bit of background and then what the problem is, if you don't mind.
Yeah, you're right, Bruce. It was sold to investors as a way to take your money that you had earned in South Africa. You'd used your offshore allowance, you'd sent it out, and the idea is, put it into something that the promoters of the product would say has been classified as an offshore pension. And the attraction for that is it means that when you die, you can leave the money to your beneficiaries, but most of the time your kids, and it won't attract estate duty. And that was a heck of a hook for a lot of people to say, that I don't mind paying my tax. I've paid my tax on this money in my lifetime before I sent it overseas, and now I don't want to keep paying tax on tax on tax. So this sounds great. I'm going to put my money into this offshore pension, and I'll be on my way, and no concerns on my death that the money goes to my kids. And it gained quite a lot of popularity over the last few years. And I think, just to be clear, it's totally different from people who've legitimately worked overseas in foreign countries. They've contributed to pension funds in foreign countries. Those are completely recognized by SARS, especially where we've got double taxation agreements with those countries, and those pensions might well be tax-free in South Africa. So that's a very different thing from when you live and work in South Africa. You take money that you've generated in South Africa, you send it overseas, and someone says to you, "Here is a new thing called an offshore pension. Put your money in here." And I must say, I got lots of questions about this in over the last few years, and a couple of these products looked quite compelling. I mean, so much so that I sent one to a tax guru, a tax lawyer, and I said to him, "Obviously, it's going to cost me money, but can you have a look at this?" And his summary was, it looks to him like some clever lawyer has looked for every loophole that he can find in the Tax Act, and he's put together this product. And so, yes, it might be legal for now, not illegal, not a Ponzi scheme or a scam or anything. But he would not bet on this, the loophole staying open for much longer. And he was right. Within about 2 years, SARS made a ruling earlier in August and very explicitly came out to shut every loophole that was available. Problem for investors now is
what happens to you now, because you've gone perfectly legally, through every loophole, and this goes to about spirit of the law rather than the letter of the law. The spirit of the law probably said, "Don't do this." The letter of the law said, "But you can." If you look really carefully, there's the gap. You take the gap, you exploit the opportunity that is presented to you. You think you're acting perfectly legally, and then suddenly somebody decides, "No, we're switching off the tap," and which SARS has done. What happens next?
Well, now those investors that have put money into these, effectively what they've got is really just a bog standard offshore trust as far as SARS is concerned. In other words, they're going to have to show SARS that they are now lending the money to the trust, or they've donated the money to the trust. If they've donated the money, they need to pay donations tax. If they've lent the money to the trust, it means that they now need to start charging interest on that money that they've lent, and they're going to have to pay tax on that. And very definitely, whatever is outstanding, whatever loan is outstanding to the trust, when the person dies, that money will absolutely form part of their estate. So what they've got now is I think, a very expensive offshore trust. And to me, there's a powerful lesson in this. When you've got products that are expressly designed, and that's the point. This was expressly designed to find loopholes. And I can't tell you how many times on this show, and in general in my career, you come across these products and you get these, the trick for me always is the company promoting the product arrives with the brochure of the product and an opinion from a lawyer. And that opinion says this product is great. And I'm not going to name names, but I mean, I looked at the brochure for one of these, and the lawyer involved was someone that that's well respected in South Africa, one of the big name tax advocates, and backing up that this product is for now okay. And that's the point. The lawyers cover themselves. This thing is okay for now. But a bit of common sense would say to you, SARS employ very clever people. And surely, if the product gains any kind of popularity, SARS is going to find out about it, and they are going to close the loopholes, because the point is there were loopholes. As you said, it's about the spirit of the legislation. And my comment to anybody is, yes, I might be old-fashioned. Yes, I might be a bit conservative in saying to you, just avoid things where you know for fact that it's designed to go through the loopholes. Don't think that SARS are a bunch of idiots. They're absolutely not, and they will find out.
So, are there rules preventing people from creating these products? No, they're not. Are lawyers paid to find loopholes? Yes, they are. I worry why the customer should now be prejudiced. Can they in any way undo what they have done? Or is this effectively a rap across the knuckles and a punishment for trying to dodge their obligations?
Well, I think they have paid for a product which is now, as I say, it's now just a bog standard offshore trust. So it's not as if the money is lost. The potential tax benefits on their death are gone. And some of the interim sort of capital gains tax benefits, which they might have banked on as well, are also gone. But that they are still, settlers of a trust is real, and that they have some benefits. So I think they're going to struggle to kind of argue that that they've lost money, but at the same time, they've probably bought a very expensive trust, and certainly there was a premium charged for the tax benefits. And my comment here is, you're right that the lawyers are paid to find loopholes, but surely when we've got money and we're investing our money, let's just apply a modicum of common sense, which is I know that's uncommon, but just understand that, nothing's too good to be true. So in this instance, it wasn't a scam, but how many times we on this show we'll look at something that is very obviously a scam. It is too good to be true, and we find people that are absolutely passionate about investing in it, and as if it's their right. And I think that's my comment is when you get a brochure for a product that's relatively new and it goes into the 10s or 20s of pages of fine print and conditions and terms, et cetera, and it's not generic. It's not a generic offshore trust or a generic retirement annuity in South Africa, whatever it is. If it's a complex product, understand the complexity there is there for a reason. And unfortunately, it's not for your benefit as the investor. It's for the product promoter's benefit. And that's really my big gripe with this whole thing is the end investor is going to pay, whether it's through lost tax savings or higher fees, etc. They probably won't be have to pay penalties or anything to SARS, but they are going to lose out. The promoters have made their money up front on selling the trust. The lawyers have made their money on getting the opinions, but the end investor loses out. And that's the lesson is don't trust the lawyers and the product promoters and even the financial planners who are pushing these things at you. Ultimately, you've got to trust some common sense and ask around. And if 4 out of 5 people are saying to you, this seems a bit too good to be true, and why don't you rather do the generic tax structuring, which is what pretty much everyone else is doing, and you go against that advice and you listen to the 1 out of 5 because you want to be cleverer than everybody else, this is what's going to happen to you. Unfortunately, this is almost a certainty.
What did my grandfather used to say? There's nothing common about common sense, my boy. It sticks in my brain like nothing else. Great question this evening, and you can ask us questions too. Your questions on WhatsApp or on SMS or email them to us. We don't care how you send them. Send them. From Jono in Cape Town is, what is the best way to invest? Do I go to a private broker? I see big consultation fees, says Jono, or find something cheaper online. Easy, like Easy Equities. I have an Easy Equities account and I've doubled with about 10,000 Rand, but would you suggest that I diversify with other investment tools, or is something like an Easy Equities good enough to invest everything with? I think you're going to suggest I diversify, but who or what would you recommend? Nice question, Jono, with Warren in a moment.
The Money Show.
Personal Finance with Warren Ingram.
So Jono is investing, he is dabbling, he is experimenting, trying things out. Should he be running his personal portfolio? Should he be going through something like an Easy Equities or going via a broker? I'm worried about costs. Understandably, these things matter. Warren Ingram at Galileo Capital. What's the thinking around the best approach for somebody who's new to this world?
I think it makes sense in the early days of your investing career to take full advantage of the lowest fees you can find. And so bulking up your money as much as you possibly can on one platform does make sense, because most of the time you get some kind of a benefit of lower fees the bigger the transactions are when you're buying shares or ETFs or the like. And so in that instance, not spreading your eggs across different baskets makes sense. But on the other side of that, and that's maybe more to Jono's point, is the platform risk is one thing. The second risk is then what you buy. And I'm certainly not advocating that you take all your money and then reduce your transaction charges by putting it all on one particular share. So I think the key there is diversify, in the early days across different investments, either exchange traded funds, or if you're buying shares, a whole range of shares. Don't just simply buy one. But if you're buying, a well-regulated, investment in a well-regulated market, which most of the time that's what South Africa is, your concerns about the platform are probably not too heavy. I think if you're dealing with larger amounts of money, then by all means, open up 2 accounts. But a lot of the time, if you're running through a bank or a large financial institution, they'll stand behind the platform. That they usually have a separate custodian, which is a completely different company from the platform. So when you're using a platform, find out who the custodian of the assets is. Make sure that it's separate from the provider, and so your risks become more and more spread. And then ultimately, if you're buying an exchange traded fund in South Africa, for example, that's actually still a unit trust in a legal structure, which means no one can access the assets of that except the unit holders or the shareholders of the ETF. So you've got quite a lot of investor protection. So for now, Jono, if you're doing amounts, around that sort of 10,000 Rand level, rather consolidate on one. And there are more and more online platforms that are offering very good, very low cost trading now. So look around, do your homework. It's not just a market of one anymore.
There's no harm, though, in managing a small portfolio. I mean, you can do your serious money into exchange-traded funds or into unit trusts if you want to with a manager and you want to pay them a fee and get them to do it. That's great, no problem at all. But this idea of sort of empowering yourself and learning how markets work, and there are very few better ways of learning it. And something like, and I don't know if anybody else has come into the market to compete with Easy Equities, but this ability to, take $10 and buy a tiny little smidge of Naspers or whatever the case might be, introduces you to a world that you're not going to experience in any other way as intensely as watching share prices move on a regular basis, Warren.
It's always a tricky one for me in this, because I feel that we can educate ourselves about investing and build up a track record of making investment decisions without committing real money. A lot of the time I'll hear someone say, I'm just going to commit some money to kind of play on the market and learn along the way. And I get the logic. I mean, just exactly as you've explained, it is a rational view, but I think it can be quite an expensive way of of paying school fees. And I think a lot of the time, a lot of the online stockbrokers will give you the option of creating a portfolio, but not with real money. So where you can make investment decisions, go through the process of buying shares, with a nominal sum of money. In other words, not a real amount actually, and you start to track your investment decisions to see whether you're making good calls or not. And yes, it's not as life or death as when you've actually got your own money on the line. But a lot of the time we're not necessarily built to be great investors on day one. We do need to learn and get the experience. To your point, I do think it's a great idea for people who have the time and the inclination to actually become their own investors. I think it's an absolutely brilliant idea, but I'm not convinced always on the idea of building it up with real money and paying the school fees along the way. I hate giving away money.
No, absolutely. You're very good at not doing that. Let's get then on to I found a phrase the other day that I thought would be interesting to throw at you. What is smart beta investing? Once we start using Greek in investing terms, I get a bit nervous.
That's because you're the alpha male. So I think it's the index provider's solution to trying to compete with the active managers. So a little bit of now I've thrown lots of jargon here, but the one thing is, if we talk about the top 40 index in South Africa or the S&P 500 in America, it's a very simple index. All it does is in South Africa, it tries to measure the 40 largest companies on the stock exchange, and you can buy an index on that. And it's very simple. It's a completely mathematical index. The criticism of that index in South Africa or the S&P 500 America is that, for example, the companies that are biggest in the exchange can account for, in South Africa, it could be almost 20% of the entire value of that top 40 index with just one share. And that is a valid criticism. And a lot of the managers who are choosing individual shares and trying to put them together in portfolios to try and beat the stock market, those are called active managers. And they would point this out as an obvious, almost fatal flaw in index investing. And so they would say, don't invest in a market cap index. It's a waste of time. It's too risky, et cetera, et cetera. And so the index providers, being the clever mathematicians they are, they came up with alternatives. And so, for example, you can buy an index which is equally weighted top 40. So it takes the same 40 companies as the top 40 index, but you allocate the same amount of money to each share. And that would be a form of smart beta investing. Or you buy a portfolio of shares that have a bias to companies that only pay dividends and potentially, especially in America, that have a 30-year history only of paying increasing dividends. That's another form of smart beta investing. So there's some sort of a factor that gets overlaid on the index, and then companies are filtered, mathematically or according to a set of rules, as a way to kind of overcome the criticisms of the normal traditional market capitalization way of investing in an index. Hope that wasn't too much Greek.
No, there's plenty of Greek in there, but I followed you, and if I follow you, everyone else is fine. And besides which, if you haven't followed us this evening, that's fine. We don't mind, as long as you go to our podcast and download the podcast so that you can listen to it and then share with people who are also looking for answers to questions similar to those that you have. If you have unique questions you want to share with us, 072 702 1702. That's our WhatsApp number. Send us WhatsApp questions and we'll do our very best to get the best answers for you here on The Money Show.